Hi, my name is Peter Knight, and I'm the Head of Co-Investments here at Connection Capital. In my role, I'm responsible for sourcing and diligencing high-quality single-asset co-investment opportunities to our clients. Co-investments are single-asset transactions, for example, a private company or property that has been originated by an independent third-party investment manager or sponsor, who also manages the investment on our behalf on an ongoing basis. Usually, but not always, the manager will control other pools of capital which will be invested alongside the co-investment. This means investors benefit from the due diligence an experienced manager has commissioned and underwritten in terms of cost, in addition to the diligence work undertaken by us here at Connection Capital. So what does this flexibility allow us to consider? Well, we arrange investments across the alternatives asset spectrum, including private equity. That's everything from Series B venture/growth opportunities through to core mid-market buyouts. Private debt, which is focused mainly on providing mezzanine or hybrid debt solutions, and commercial property. Geographically speaking, we prefer opportunities in the UK and Europe. The popularity of co-investments has increased markedly in recent years. The flexibility of the co-investment model means that managers are using co-investment as a way to increase their total assets under management, to participate in larger deals without breaking the concentration limits of their main fund, and to raise continuation capital for trophy assets that they'd like to remain invested in. As such, managers are increasingly offering co-investment opportunities to investors that may not already be a limited partner or an LP in their main fund. Another industry trend that we're witnessing is the rise of the fundless sponsor. Managers that have decided not to raise a blind pool fund and to raise their capital on a purely deal-by-deal basis. In these instances, co-investment is the only way of accessing these opportunities. Co-investments can be thought of as a hybrid of direct investing and fund investing. You're delegating authority to a third-party sponsor to manage your investment on an ongoing basis, but remain in complete control as to which single asset exposures you invest in. As such, there are many benefits to investing via co-investment which other forms of investment cannot provide. Co-investments allow Connection Capital clients to build greater levels of single asset diversification into their portfolios. By partnering with specialist asset managers, we're able to provide access to companies that are either at an earlier stage of development, typically from Series B onwards, right through to participating in larger rounds where the underlying company has an enterprise value of, say, £100 million or more, where an asset is in a particularly niche sector or, for instance, in a new geography. Partnering with specialists with demonstrable track records gives investors the assurance that the deal is being managed by an expert in that area, in addition to the scrutiny Connection Capital subjects the deal to at outset. Unlike investing in a fund, there is no blind pool risk with co-investments. You control your exposure by choosing to invest in a specific single asset, rather than investing in a fund and a manager having full discretion over the allocation of your capital. Co-investments can also have shorter periods to distributions and exits than an investment in a typical private markets fund. This is because in a co-investment, capital is being deployed into the asset immediately versus a fund model where there can be a separate fundraising period, often taking 12 to 24 months, and then an investment period to put those funds raised to work. Finally, co-investing also offers access to transactions that aren't run through funds and may not arise from traditional private equity firms, such as fundless sponsors. Our sourcing strategy is a mixture of inbound and outbound contact with our extensive alternative assets network. Regardless of the underlying source, we find the most important factor in originating high-quality co-investments is through the relationships we have built within the private markets industry over a long period of time. This is very difficult to replicate or shortcut. The most obvious source of co-investments is from managers with whom we already have a fund allocation. The nature of our fund's portfolio, which covers a diverse range of private market strategies, sectors and geographies, coupled with the excellent relationships we've cultivated within the investment managers, means that we see a steady stream of differentiated, difficult to access co-investment opportunities. Connection Capital is considered an attractive partner by a range of investment managers, given we typically have appetite for a variety of opportunities that few investors can match. From investing alongside non-traditional managers such as funder sponsors, participating in secondaries deals, funding continuation vehicles, across the full suite of alternative asset classes, we're seen in the market as a flexible, collaborative partner, which in turn provides us access to the best opportunities for our clients, wherever those opportunities may be found. The fact that we already have both a co-investment and fund investment capability further enhances our attractiveness as a partner. Connection Capital has a long history of both direct investing and fund investing, with our track record demonstrating our ability to source, identify, execute on and manage individual assets, as well as diligence and access the best managers within a specific sector or strategy. Our team utilises both of these core skill sets when reviewing a co-investment, diligencing both the underlying asset and the deal terms associated with it, as we would any of our own direct investments, as well as the manager themselves, to ensure that they have the necessary skills, expertise and capabilities to manage the investment successfully on behalf of our clients. This dual-track approach sets us apart from many other participants in this space. A large proportion of investors utilising co-investment typically come from a fund investing background. Specifically, their area of expertise is exclusively, or at least predominantly, in manager selection, and not in single asset evaluation and execution. We believe that having both perspectives is essential to successful co-investing, and that relying on only one or the other of these approaches risks reducing the overall risk-return profile of the portfolio. Raising capital on a deal-by-deal basis allows us to consider a very wide range of opportunities. We not only benefit from not being constrained by sector, regional or other concentration limits that a typical fund would be bound by, but by partnering with expert managers, we can consider opportunities that fall outside of Connection Capital's existing direct investing focus. We also give a great deal of consideration to the deal dynamics. What is the motivation for the deal? Is the co-investment opportunity the result of a broken process? Are there timing pressures? Has the deal already been completed and is it being syndicated down post-close? These, and a whole host of other questions, are the ones we ask when presented with a potential investment. Opportunism, our flexibility, and being in the right place at the right time can be very valuable and result in attractive pricing to the benefit of our clients.